What are restructuring charges? Have you ever wondered what happens behind the scenes when a company decides to reorganize? Today, we are going to talk about restructuring charges and what they mean for businesses. Restructuring charges are one-time expenses that a company incurs when it reorganizes its operations. This can happen for various reasons, like improving efficiency, reducing costs, or adapting to new strategies. When a company decides to restructure, these charges are recorded as non-recurring operating expenses on the income statement. They reflected costs related to significant changes, such as downsizing, closing facilities, or realigning business units. From a tax and accounting perspective, these charges are important because they representing anticipated costs associated with a planned reorganization. Companies recognize these charges in the period when they commit to the restructuring plan. This means they take a one-time hit to earnings upfront, covering all expected costs related to the restructuring. As a result, no further charges should arise later from the same event. Common types of restructuring charges include employee severance benefits. This includes payments like severance pay, continuation of benefits, and outplacement services for employees laid off due to restructuring. These costs are recognized when the company commits to the layoffs and notifies affected employees. Another type is facility closure costs. These are expenses related to closing or consolidating offices, factories, or warehouses. This can include lease termination fees, asset write-downs, relocation costs, and other expenses to downsize operations. Asset impairments are also part of restructuring charges. When restructuring leads to a reassessment of long-term assets, like equipment or buildings, assets no longer expected to generate future economic benefits are written down to their recoverable amount. The impairment loss is included in the restructuring charge. Additionally, there are contract termination costs. These are fees and penalties incurred from canceling supplier, service, or customer contracts as part of the reorganization. Legal and consulting fees also fall under this category. These are professional fees for legal, financial, or strategic advice directly related to planning and executing the restructuring. In accounting, restructuring charges are treated as non-operating expenses because they are infrequent and not part of the company's ongoing business activities. Properly recording these charges ensures that financial statements accurately reflected the costs of the reorganization. This provides transparency to investors and stakeholders. From a tax standpoint, restructuring charges may be deductible expenses. However, their treatment depends on local tax laws and the nature of the costs incurred. Companies must carefully document these expenses and the restructuring plan to support their tax positions. In bookkeeping, practical application involves identifying all costs related to the restructuring event. It also includes recording the total estimated charge in the period when the restructuring decision is made. Adjustments for actual costs should be made as they are incurred. Disclosing the nature and amount of restructuring charges in financial statement notes is essential for clarity. It is also important to note that restructuring charges can sometimes be used by management to manipulate earnings. By taking a large one-time charge, known as a big bath, they can reduce current profits and improve the appearance of future earnings. Analysts often scrutinize these charges to assess the company's true financial health. In summary, restructuring charges representing the anticipated one-time costs of reorganizing a company's operations. They are recorded upfront to reflect the financial impact of strategic changes, with specific accounting and tax implications that must be carefully managed and disclosed.